Hi, Professor. This is Chien-Hao saying. For week one's assignment, I would like to use the music industry as an example for the presentation. And more specifically, I'm going to walk you through how a record label accounts for citing and monetizing an artist, and whether the way these deals get reported in the press lines up with the GAAP rules. So here is the scenario. Harbor Light Records, an independent label, signs a new artist called Nova Race to a standard record deal. Over the first year, three things happen financially that mirror exactly what happens at those major labels like Universal or Warner. First, the labels pays Nova a $1 million signing advance. Secondly, they spend $500,000 recording her first single. And thirdly, once the single is released, it earns $300,000 in streaming royalties. On the surface, these sounds like three simple cash events, but each one gets treated very differently under accounting rules. And that's the topic of this analysis. So let's start with the events. Harbor Lights pays Nova $1 million upfront. We might expect that to hit the books as an expense, but that's not how it works because this expense is recoupable, meaning that the label can claim it back out of Nova's future royalties. It is actually recorded as an asset. So the entry is a debit to artist advance for $1 million and a credit to cash for $1 million. Notice the accounting equation doesn't move at all here. We're just swapping one asset, cash or for another asset, a recoupable event. Next, the label spends $500,000 recording the single, built on account rather than paying cash. Again, common sense might say expense it, that money is gone. But under ASC 926, the accounting standard for entertainment and music production cost, the label can actually capitalize this as an asset as long as it is probable they will recover it through future royalties. So we debit capitalized recording cost for $500,000 and credit accounts payable for $500,000. This time, both assets and liabilities go up by $500,000. Equity is untouched. Now, the single is out. Uh, so the single is out. It earns $300,000 in streaming royalties. Under ASC 606, the label recognizes this as revenue as soon as it earned, based on actual streaming usage, not when the cash physically arrives. So we debit account receivable for $300,000 and credit royalty revenue for $300,000. This increases assets by $300,000 and increases equity by $300,000 through revenue. But here's the catch. Nova doesn't see a dime of this yet. It gets applied against her $1 million advance first. So what does this tell us about how the media cover these deals? Headlines often says things like the label spent $1 million signing the artist, which makes it sound like a loss. In reality, this is an asset. Or they will say that the album cost $500,000, framing it as sunk cost, when it is actually a capitalized investment the label expects to recover it. And probably the most misleading one. When the song makes $300,000, people assume that the artist is getting paid, but she's not. not until she is recouped. The underlying accounting here is actually accurate and follows GAAP closely. The real problem is communication. The gap between what these terms means technically and how they get reported to the public. Okay. So to wrap up, my analysis is grounded in the FASB's own revenue recognition and the entertainment industry standards, along with entertainment accounting sources and standard financial accounting textbook, all listed here. And here's the references. Thank you for listening.